Well, hi there, Marla. How's it going?
Pretty good. How are you?
I'm doing good, thanks.
That's great. So I have a question for you, Debbie.
Yes.
Have you ever had a client buy a car after they applied for a mortgage? And is that a bad thing?
Yes.
Oh, good. So today we're going to talk about why that's a bad thing. I'm Marla Wong.
And I'm Debbie Wong.
And this is, we're the Wong Real Estate Group. And
Yes,
this is
we
Real
are.
Times in Real Estate.
Yes.
Yay. Okay, so Debbie, why is it bad to, or not a good idea to buy a car after you have applied for a mortgage?
Well, the reality is that, with the internet and with everything being online, all of your stuff being online, right, is when you get qualified or in the initial process, they're basically asking you some questions. They're putting in your information into a desktop application, the bank is anyways, and then they run your credit and everything looks good, and you'll get a pre-approval based on that initial look. And then when you find a place and make an offer, then that's when the real process begins. And the bank is sort of relying on everything about your credit as being a snapshot in time. So if you do something to change that picture, if you will, of your credit worthiness, then that absolutely changes what you could qualify for. So the reality is that, for example, when you buy a car, it's a very large purchase. And even if you are leasing the car, the payment is still a pretty large chunk of what your income is every month. So if you had applied before getting a new car or vehicle, then you're basically pre-approved for that snapshot of your credit. And then when you do something major, like make a big purchase, like in that way, that changes the picture of your credit worthiness. So yes, oftentimes, especially, a really great loan agent, and we partner with some really great people, they will always advise their customers, not to do that, or they'll send them, like information pamphlets or advisories on, what to do to get ready for the pre-approval process and that kind of thing. So buying a car is the worst thing you can do.
Oh, okay. I have a nifty little list here of things you should not do after you apply for a mortgage. Don't change bank accounts.
Oh, that's huge. Yes. Let me just say something about that really quick. And sometimes people do things because it seems logical to do it. So for example, let's say if you've got 20% down and you've got some money in a retirement account and you've got other money in a checking and some other monies in a savings or something. Some people think, well, wouldn't it be like logical to pull all of those monies, pull them all together into one account? And actually, that's the worst thing you can do. Because again, in the pre-approval process, they're looking at your credit and they're looking at where the monies are coming from and how long has the money been at that source. So if you move all the money around and put them into a new source, then the money has to be aged, if you will, in that new source, or seasoned, like if you will, in that new source, like that new banking source. So that's the other thing too that we often tell our customers is don't move your money around. If it's in 3 places, just leave it just like that. Because part of the pre-approval process is that they do want to see copies of your bank statements and all that kind of thing.
And so it's okay to turn in like 8 different statements or 5 or
right, as long as they all add up together, you're okay. But what they don't want to see is have chunks of money disappear from your accounts going into one other account, because then you have to let the money season. And I think that's to help avoid money laundering or any type of fraudulent activity, that kind of thing. So, yeah. So don't buy a car. Don't move around your accounts. What else you got on that nifty list of yours?
Well, I have don't apply for new credit or close any credit account. So I think we talked about that one.
Well, if I could just add a couple more tips. Yeah. So when you open a new line of credit, they actually have to, like, so say, for example, you go to a department store, or you're going to get a line of credit from a bank, a secondary loan or something of that nature. What ends up happening is you end up getting your credit pulled to qualify for that. And so that's one thing too, that the lenders, when you're trying to get a mortgage to buy a house, that's something that they'll look at, or it might be a red flag for them. Also, don't close your accounts, because when you are thinking about your FICO score, you get points for certain things about your credit. And when you have open lines of credit that you've been paying regularly, or have low balances on, or whatever, you get a score for that too. And if you start closing accounts, then that could theoretically affect your score. So don't want to do anything like that. And typically in the pre-approval process, our wonderful partners that we work with, our lending partners, will analyze that for our customers and make sure that, and give them advice too. So like, for example, we had one situation where we were helping a gal get into her first place, and her advice was, okay, well, you've only been in this job for X number of months, wait 6 more months, save X number more of dollars, and pay off these two loans, these two lines of credit, and that will dramatically improve your score. So
they give you tips to improve
they
your
do.
score.
Really great lenders do that, and that's why it's really important to work with the right people.
Okay. So don't make any large purchases. We talked about not buying a car, but like, what is like the minimum of a large purchase? Like how do you define large?
In my humble opinion, it's anything over $500. In my humble opinion.
So don't buy any new like Jimmy Choos or anything.
Yeah, no new shoes. Who would spend $500 on Jimmy Choos? I think they cost more than that now. I think they cost like $1,500. But anyways, don't do that. And don't buy furniture or a sofa or things of that nature.
Wow, I didn't even think about that.
Yeah. So people forget that furniture is also expensive. And again, if you're just starting out in the process, work with your favorite agent, and they typically will partner with somebody who can give you all of this advice as well. Or you can connect with us and we'll give you really great advice too.
Yes. And I have, don't deposit cash into your bank accounts before speaking with your lender.
Yes, also very important, because sometimes we have customers where the parents or grandparents might help out in the down payment process. And so they might say, here, Johnny, here's like $100,000 because you've been such a great grandson. I'm going to help you buy a house. And so if they make a deposit in there, they may not be able to use that deposit because maybe the money was only recently deposited. Again, the money has to be seasoned, right? It has to be in an account for a certain number of days. And I believe it's 60 to 90 days. Yeah. The best way to do it would be to have Granny wire transfer the money into escrow. That's the best way to make a gift. So just a tip out there for all you folks that have nice grannies or parents that want to help with the down payment. The best way to do it is to wire transfer it to the escrow.
When we were talking about the subject, I had a little ADD moment. Have you seen Magic Mike?
What does that have to do with
Because he couldn't put his money in the bank because he was a stripper, so it was all in like one.
Oh my God. Yeah, I remember the water. I saw that movie. That was a great movie.
And I was
hilarious.
Just thinking, like, what if?
Because they were asking, where did you get this money from?
Because he couldn't get a loan for his business because all of his money was in like ones in a suitcase.
Yeah, all at ones in a suitcase. And he worked hard for the money.
He did.
Right. Yeah, he did.
Oh, he worked that. He worked it for the money.
He did. That was a great movie, but they enjoyed it very much.
It was very,
Is that an appropriate movie?
I don't know. But I was just thinking about that, like,
The things you think of, Miss Marla.
Anyways.
Okay.
And so I have on my list, lastly but not leastly, is don't co-sign other loans for anyone.
Yes. People don't realize that when you co-sign for someone, even if it's a lease. So for example, let's say you've got a niece or nephew that need a guarantor for the lease, that actually could potentially affect your credit. Or let's say your son or daughter is going to buy a car and they need someone to co-sign for the loan on the car. That will affect your credit because you're responsible for that debt. So yeah, don't co-sign for anybody on anything without first checking with your realtor and your lender partner.
Okay. Well, so I had 5 tips on this list. Debbie, do you have anything else you want to add?
Yeah, my advice is get pre-approved for your loan. First of all, I think coming to the realization that you would like to buy a home, I think that's probably a pretty big deal. I think whoever comes to that realization that they want to try it and they want to grow in that way and grow their wealth, and it's a big step. So for those of you that are thinking about it and think that, yes, I'm going to do this, I have to congratulate you and, give you accolades for that, because it's a little stressful. It's a little scary, but once you've decided that you're going to commit to the process, then that's wonderful. And the best way to go about it is to get pre-approved. So before you start shopping, is figure out what is your purchase power, and figure out, what would be the best way to get the best loan for, your income earning parameters, that kind of thing. So because knowledge is power. And the cool thing is the way that we like to work is whatever home we show you, we've already gone through that process. So we have great certainty that you can afford to buy that home. And there's something to be said about that, because having a comfort in knowing that, hey, I'm looking at something I could absolutely purchase, there's a great comfort in that.
There is, yeah, and just being prepared with that knowledge, it's like you don't have to go out there to make 50 offers on something that you can't afford. Whereas if we show you something, you can it's definitely in your price range, and then it's like you have a better chance.
Well, I don't think
winning.
Anybody should be going out there making 50 offers. I think if that's happening to you, we definitely need to talk to you, because it shouldn't go that way at all. But yeah, I think this was really great. I'm so glad that you brought this up, because I think a lot of people don't realize how much this can really affect their chances.
So let me just recap. So don't change bank accounts. One, don't apply for new credit or close any credit accounts. And don't make any large purchases. Don't deposit cash into your bank accounts before speaking with your lender. And don't co-sign for anyone. And
don't co-sign on any loans for anyone.
Or
that would be houses or auto or any type of credit thing. And I'm even thinking maybe not even... don't even co-sign on a lease of any type.
That makes sense. Well, so this has been Real Times in Real Estate. And if you liked our topic today, please subscribe to our channel wherever you get your podcasts, and on YouTube. And thank you so much for joining us today.
All right. So until we see each other again,
Bye-bye.
Stay safe.